All right, Brian, let's talk about the 30s. We talk about this a lot on the show. This is the messy middle. This is where things get a little complicated because we have 1,000 different things pulling us in 1,000 different directions, and it seems like we don't really have time for anything because we have to try to make time for everything.
Well, we say the days are long and the years are short because not only are you feeling like you're short on money, because definitely a lot of things pulling at your back pocket and your purse, but you're also short on time because you got all these commitments, not only with your job, but your community as well as your family. There's a lot of stuff that makes the 30s that messy middle. So how do we attack this?
Yeah, so as you're thinking about the financial planning pyramid, as you think about your cash flow and spending, one thing that you have to keep in your mind is that it's likely you are in a different income situation in your 30s than you were in your 20s. You want to make sure that your savings rate also matches that. Don't be a person with a 30-year-old's income but a 20-year-old savings rate. That's not where you need to be. As you have pay raises, as you have promotions, as you have circumstances change, make sure that your savings rate is also maturing with you.
Yeah, it makes me sad when I find out somebody got on the behavior of maxing out their Roth IRA when they were, say, 25, 26, and then they get into 32, they've had 5 pay raises since then, and still the only version of investing is maxing out their Roth IRA.
Doing.
You don't invest like you did when you were in your 20s. Keep progressing, changing, updating to what reflects in your life. That's why we always talk about the savings rate, and we'll get into that, what that means for investing, but focus on that and then avoid lifestyle creep.
Yeah, you got to avoid looking out for those lifestyle creeps because they're going to show up in your 30s. The Joneses are going to be right around the corner, and you want to make sure that you're not falling into the trap because in your 20s, you can have mistakes that happen by the tens of dollars or the hundreds of dollars. But as you get into this decade, as you get into your 30s, now the uh-ohs happen by the thousands, and they can have a meaningful impact on your financial life. So don't let your life start creeping away from you. And unfortunately, we see far too many people that this does happen to.
Well, there's some big expenses. Housing's one of them.
Huge.
And it's such a hard time right now. So don't be mad, but this is a unique time where maybe renting is better than owning in certain markets in the community. And you can evaluate that. We even give you a checklist. If you go to moneyguy.com/resources, we have a housing checklist because what you're trying to overcome is all this inflation, all these things that ran housing up. How do you mitigate that, and how do you make sure you're making the right decision for your household?
And if the house is probably the most expensive thing that you're going to spend money on, the car is probably the second most expensive thing you're likely to spend money on. And we see so many people making bad decisions when it comes to their automobiles. Listen to these statistics. The average auto loan term for a new car right now is 68 months.
That's incredible.
The average amount financed on a new car has risen to over $41,000, and the average amount of negative equity that's rolled into automobile purchases is over $6,000. Brian, that is a far cry from the rule that we tell people when it comes to buying a car. What's the right way to do it?
Well, we talk about 23/8. That's where you're putting 20% down. You don't finance longer than 3 years, and you make sure your monthly payments don't exceed 8% of your gross income. Here's what I think is so sad. I even saw this on Twitter where people who are putting out there that they're somewhat successful. You know, you look at their Twitter handle and you see what they do for a living, and it has all this razzle-dazzle to it. And then they're asking questions where they have like $18,000 of negative equity. And you're like, well, maybe that's just a one-off. But then you find out in this stat of how much financing is out there is that the typical car that's traded in right now has over $6,000 of negative equity. Guys, quit faking it. Nobody cares what car you're driving. And when we talk about 23/8, this is Toyota Tercel. This is, the Corolla, something. I don't even make the Tercel anymore. But the Corolla, we're not talking about the Land Cruisers. We're talking about the Honda Civics, the Corollas, and those. You need transportation that reliably gets you to your job. This is not something to flex on. And that's the part that I struggle with is people making those big decisions. In your 20s, they were $100 a month mistakes. Now they can be thousands of dollars of mistakes. Don't fall into it because you're stealing from your future self.
It's interesting, Brian. You say the job. That's another thing that you ought to be thinking about in your 30s. Do I just have a job, a clock in, a clock out, or Or am I actually working towards a career? Am I in a vocation? Am I in a field that's going to set me up to continue to be able to advance? Or is this just a job? I would argue that by your 30s, you should begin starting to have some clarity around what your career should look like. But again, Brian, I think a lot of folks, they don't have that.
Yeah, there's a lot of, you can tell because the stats show it, 58% of Americans are planning a major job change, and only 33% of workers are satisfied with their opportunities for promotion. That shows that a lot of us are on Sunday chewing our fingernails or having a lot of anxiety about this. Guys, take an inventory of where you are, because I mean, we spend so much time with our work family. Make sure that the job actually is a career, because you're now in that second decade out to where it needs to align with your long-term objectives and even your happiness. Don't just take that for granted.
We talk about this all the time, specifically when it comes to like compounding and savings, but we always say that wasting time is way more expensive than wasting money. Well, that's even true in your career field. What you don't want to do is wake up at 40, wake up at 45 and say, man, I wish I would have made a change. I wish I would have pursued. I wish I would have gone back. If you are in that place right now, start figuring out what things you need to change, what pieces you need to move around in your life so that you can begin living the life that you actually want to be living. Don't let time pass you by and you wake up 10 years from now with regrets.
I still think this is a young decade. Your 30s, a lot of exciting stuff, but you shouldn't, just because you're having a good time and a lot of distractions out there, don't skip risk management, because here's why this is super important. More than likely in your 30s, someone out there is dependent upon you or counting on you, whether it's your income or whether it's what you do for them. So make sure you're not skipping out on life insurance, disability insurance. This is an important decade because people are counting on you.
The other thing you have to make sure, and for that same reason, is that you do have a fully funded emergency fund where you could probably get away in your 20s with fudging it a little bit. In your 30s, you can't fudge it, because if something bad happens to you, if that emergency happens, that job loss happens, that car repair happens, whatever that thing is that happens, you want to make sure it does not derail you and derail the folks that are depending on you. So in your 30s, I'm going to argue, it's non-negotiable.
And then I'll close out the risk management, umbrella insurance. You're like, what's umbrella insurance? Yeah, because I don't think a lot of 20-somethings are out there talking about umbrella insurance on Reddit and so forth. But it is, once you get into your 30s and you have houses, or you have a house, I should say. You have cars, you have a house. Umbrella insurance, just like the visual kind of plays itself out, sits on top of whatever the coverage you have from your homeowner's policy, your automobile policy. That umbrella is going to give you additional protection. So, and it's pretty cheap. You can, I always tell people, look at what your net worth is, see if you can insure that, just because it takes the target down a little bit or protects you as your target gets bigger as your wealth grows.
Now, we talked about, Brian, how the emergency fund is sort of a non-negotiable in the 30s because it's so important. I'm going to argue there's another non-negotiable that starts to happen in your 30s, and that's investing 20 to 25% of your gross income. We say that's the amount that you should be saving to be able to work towards financial independence. Well, it's hard to do in your 20s. You already said in your 20s you're broke and you don't have a ton of money. In your 30s, you need to be working towards that goal, because if you can start investing 20 to 25%, you are going to be able to control what your future looks like. If you continue to wait and you continue to let time move by without taking saving and investing seriously, it's going to be really hard for you to catch up in the later decades.
And don't get distracted by the kids. Look, in your 30s, you're likely going to have a child, and it's in that decade where, because you go see this beautiful young child before you, and you're going to love it more than anything else you've loved. That does not give you permission to quit saving and investing for your retirement. You save and invest for them after you're doing 20 to 25% for yourself. Saving for your children is a step 8 of the financial order of operations. Don't get it out of order.
The other thing that might happen in your 30s is you may graduate past target retirement funds. We say that target retirement index funds are a great solution for those folks who are still early on in their accumulation phase. But once you begin to hit critical mass, once you start to approach the escape velocity of your portfolio, you may want to start moving to a more specialized investment plan, not just a generalized investment plan. And you'll know that when the gravity of your financial decisions starts to become significant, when you start thinking about the rates of return I'm earning on an annual basis, maybe more than I'm earning, maybe more than I'm saving in a year. If you get to that place, then you want to graduate past target date funds. But savings is still important.
Well, it's very important because I think a lot of people, you get some celebration moments. This is going to be the decade that you get your first six figures in investing likely, and then you're going to watch it grow into 200,000, 300,000. You're like, man, do I even need to be saving? Yes, you still need to be saving and investing. But just because you've had some success, don't take your foot off the accelerator. Always be buying. Also, this is going to probably be the decade that since your accounts are now in six-figure and beyond, your emotions are going to kick in when the market has a downturn, because it's more likely there's going to be two downturns in a decade. So be prepared. Don't get distracted. Always be buying, but focus on that savings rate while you're going through this intense season of life.
Now, I'm going to argue that in your 30s, it's a high likelihood, in my opinion, that age 31 and age 39 are going to look very different. And so one of the things you have to think about as you're thinking about your financial planning through this decade is, how am I approaching tax planning and tax management? And so one of the decisions that you may have been making previously is, hey, I'm doing Roth 401k and I'm putting money in my Roth IRA and I'm really building up that bucket. But as your income increases and as you begin to have more income, maybe you get married and the household income gets higher, you want to make sure that at least annually you are assessing, does it make sense for me to be doing Roth contributions, or should I be doing traditional contributions? Which one makes the most sense for my situation right now in this year? And reevaluate it at least annually.
And I probably sound too much like a CPA, but it is, because I am one, is that make sure that you're actually not getting so busy with the messy middle that you're not doing taxes or you're procrastinating on your taxes. Because here's why this is a problem, is that if you do your taxes early, if you're getting a refund, you get that money that much sooner so you can deploy it, your army of dollar bills, in better ways. But if you owe money, if you can get your taxes early, you at least get a month or two to figure out before April 15th where you're going to come up with. The big thing, make sure that you're making it happen. If you do find that your life is too complicated or it's too busy, maybe this is the time to hire a tax professional as well.
Now, if you are someone in your 30s and you have gotten married or you have started to have kids, your estate planning needs and circumstances do change. If you have kids, I'm going to argue that you must, or you highly recommend you have a will in place, because at the end of the day, if something were to happen to you and your spouse or you and your significant other, you want to make sure that you are putting your wishes on paper for who's going to step in to provide and care for those children. And I know that's a hard decision to make.
Well, yeah, because Bo, my sister-in-law is different than, or my brother-in-law. If you were I'm just saying hypothetical.
Yeah.
Don't judge us off of, but I don't want to upset them. And then maybe my family has this weird thing going on. Her family has this going on. I don't want to have that uncomfortable conversation.
If you think that conversation is uncomfortable now, wait till that conversation has to happen when you're not there to speak on behalf of your kids. Because then what you get is you get family infighting and people trying to decide what they think that you wanted to have happen. If you can put it down on paper and you can have it written out, there's a high likelihood you will remove some of that stress, remove some of that tension, so that your wishes and the best wishes for your children will actually be carried out. Not only in terms of who's going to take care of them, who's going to watch them, but also how is the money going to be handled? How is it going to be stewarded well for their benefit? You want to make those decisions now while you can, and not trust someone else to make them later.
Yeah, go check out the beneficiary designations. That's very important. Don't skip out on the life insurance discussion, and then have the hard conversations. We just talked about guardianship is a hard one. That's why we tell you really need to have an estate plan and a will if you have children, so you don't have that chaos. What also goes into who's going to be the executor. If you're going to have trust within your will, who's going to be the trustees on those? Don't wait and let the state make those decisions.
And don't let them be surprises to the people either.
Yeah, I mean, if you're going to name somebody as an executor, give them a heads up, because that's one of those things, because there is a lot of responsibilities that go into that. And also good conversations as you're building your financial foundation. Be transparent, be open so that people know what's going on, and good communication is so much better than letting chaos just kind of happen and enter the situation that's already going to be sad when you pass away.